Well, good morning and welcome to your Financial Empower Hour. I'm Jason Cryderman with Great Lakes Investment Advisors. I hope you're having a beautiful, beautiful Sunday morning if you're listening to me on a Sunday, or having a great day if you're listening to me any other day of the week, whether it's on a re-record, it's on my website, it's on one of the multiple resources that we're on, multimedias, or even watching me on YouTube. And if you are watching me on YouTube, you can see in the studio today, I have my guest, or I'm sorry, my host, Mr. Tony Shore. But Tony, we also have an awesome guest in the studio with us, coming direct out of the Gradient headquarters in Minnesota. We have one of the best portfolio managers, in my personal opinion, in the world, Mr. Keith Gangl.
This guy right here. Yeah.
That's Keith. Him right over there. Yeah. Keith, how are you, buddy?
Good. How you guys doing? Glad to be back.
Good. Doing really glad to be back. Thank you so much for joining us today. So Keith, as you probably know from being on past shows, is for the first 5 or 10 minutes here, Tony and I like to catch up on the weather and the kids and family and sports and just life, right? To just to kind of see how each other's been doing, and then we dive right into the topics of the show. And so for my viewers and listeners today, you're going to hear a little different because you're going to hear from Keith a little bit about his family and his life and what keeps him busy and how his summer has been going. And guys, I can't believe it. As we sit here and record on August 17th, I can't believe it. By time this actually airs on the radio, my kids will be getting back to school that next Monday. It's crazy. Like, summer's almost over. The kids are going back to school. Our days are getting shorter, believe it or not, already. I think I had heard somewhere, and you guys might know this, but I heard somewhere we're losing 7 to 9 minutes of daylight per day right now. There's actually changing of, I wouldn't really call it the colors in the trees over here yet, but we've had some leaves you can see are starting to maybe wilt a little, and some actually fall in my yard. So it's been crazy, but fall's setting in, summer's almost over. I've been super busy with my kids, as you guys both know, and all my listeners and viewers know. Football season is gearing up. As a matter of fact, tonight Carson has his first full football practice for 8th grade tackle football.
Football already.
Oh, football already. He's all excited and geeked up. And Josie had her band camp last week, so they're all ready to get going. She's going to be the junior drum major this year at Meridian High School, as well as the on the sideline cheer team. And then 2 days after this show airs next week, we move Lexi back down to Michigan State for her sophomore year. So it's crazy busy in our household. So Tony and Keith, tell me a little bit about what's been going on with you guys, how the summer's been, and what you guys are doing this fall.
Well, yeah. I'll go ahead, Keith.
Nope, all right, I'll jump in. So mine's kind of a carbon copy of yours, Jason. Like we talked about, Mike. I have 3 kids as well. So our youngest is now going to be a sophomore in college. Same thing. So he'll be moving in next couple of weeks.
Yeah.
And then the other 2 are on the older than yours, are younger. So then those 2, they're kind of boomerang back, Tony. They're back in the household for one's on year 7 of going to college for being a pharmacist, major. So she decided to move home this year to save a little bit of money while she's going to the University of Minnesota. And then the middle one, she graduated with a nursing degree, just kind of like you got in your household at one point in time, right? Right, Jason?
Right.
So you have that.
Yep.
But yeah, so Amy, and then so she's gonna live at home for the first year until she figures out. She's at a hospital. She got her first big girl job, and she's working there. So yeah, a lot of same thing. And then leaves and acorns are dropping. I live in the country as well, so I was sitting on the deck this weekend, and dang, I almost got hit in the head a few times from acorns falling off the trees already. So
you're right. I was actually sitting out in my barn this past weekend, and I heard bang 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 these.
Yeah.
And I'm like, what the heck is going on? So I ran outside thinking and it was just acorns falling out of the trees, hitting the roof of the barn, and then of course they're all over the yard. So you're absolutely right. It's that time of year too, isn't it?
Yeah. That's what I got. That's what I have going. Tony, how about you?
Yeah, same. We're empty nesters, but my youngest was still living at home while she was going to college. And now she's a flight attendant for Delta. And so she's rarely here, but she does use this now it's a crash pad. Our house for our youngest has become a crash pad because flight attendants have a home base, and it can be in any major city where the airline has a a base of operations like Atlanta or Minneapolis. Well, her base luckily is Minneapolis. So to save money, we're her crash pad here, but she's gone on so many flights, and then they'll put her up. We'll look at, I have her on Find My Friends on my phone, I can see where she's at. My wife and I get a kick because, last night we're looking in it. Oh, she's in Miami. And then this morning we look, oh, she's in Denver. She was in Miami last night. What the heck happened? And then she's all over the place, right? So
how long has she been a flight attendant, Tony?
This is relatively new. She went through about 7 weeks of Delta is the best airline to work for. They pay the best. They have the best benefits, but they also have the hardest training. I mean, she had to jump out of this plane into water with the vests and help people down the slide. They do so much training. She had to memorize every different kind of airline. She can tell you about a Boeing, the 735 or 33, whatever it is, versus an Airbus, whatever. They all have different safety features and doors.
I never thought, thinking about taking flights, right? So we all sit in those seats, and when they give the stewardess gives the safety thing ahead of time, and she brings down the mask, and they do the seat belts, and then of course it says if there's the evacuation slides, if heaven forbid we have to land in the water, the slides go out. But you just said she actually, in training, not only did she have to learn how to do that in training, right, and be perfect, be really good at it, she actually had to simulate. You said she actually jumped out of the plane, down the slide, into the water to help people as if it was really happening.
Yep. They run through it many times.
It makes sense, right? I mean, real life training, like God forbid if it does happen, how the heck the stewards kind of know what they're going to do and how to do it. But I never thought, gee, in stewardess training, they're probably gonna have to really in real life jump out of the side of a plane into some water.
7 weeks, 6 days a week, 10 hours a day was the training. And at night you study for tests. And 30%, I think her class going through of new recruits had about 180 people.
Okay.
30% did not make it through training.
Wow.
And I have a new respect for flight attendants, at least Delta flight attendants, because they have to learn so much. And then they have to deal with us passengers, right?
Well, that's the worst part of their job, right? I mean, that's the worst part of their job. They got.
I've heard some stories.
It's not a big deal to them. Pushing the food carts, all this. It's the people on the planes. The passengers, absolutely.
And she said the good news about that is normally it's not a problem, but every so often she'll have a flight where there's one or two people that just cause trouble. Yeah,
I've seen a lot of it. I've never been on a flight that actually had a big problem. I mean, we've been on where maybe some people didn't get along for a minute, but for all intents and purposes, it's been great flights. Everybody got along, but you do see that, right? You see where all of a sudden you'll see it on the news or on social media where they've had to actually kick somebody off the plane, like couldn't take off or even call for an emergency landing because they've had some disorderly thing going on. And
she had a plane that got delayed. They hadn't left the ground and they had to delay it and come and get the passenger off.
Yeah. I just don't understand people. I mean, come on, can't we all just get along, figure it out? If you don't,
it's unbelievable.
You're not supposed to be there, you shouldn't be there. But if you are, just behave, right?
Yeah.
Just behave and wait till you get to your next destination, move on from there.
Yeah, exactly. So we're doing good. The empty nest thing is fun in a way, but we did get together recently over the summer and rented this cabin in a beautiful woods. It's kind of like on stilts. And so all three of our kids and their significant others and my wife and I all stayed for a long weekend in the cabin together and played card games, went on hikes, and that was neat. I'll tell you, once you're an empty nester like we are and you don't see your kids much, and you don't, especially all together, when you do get together and can bring them all together, it's just very special. I have to say that.
Yeah, I'll bet. I mean, we've noticed that. I'm sure you have as well, Keith, especially having two of them away and now three. But we've noticed it just with Lexi being out of the house for her first year at college, that whenever she did come home, boy, Carson and Josie, sure, they looked at her differently. They talked to her differently. They wanted to be around her. They didn't want her to, leave the right school. And of course, mom and dad missed her to heck as well. But we've noticed that even with just Lexi out of the house. So I can't imagine, Tony, like you said, when all three of them are gone, and then we get a chance to have them all come home or get back together again, like you guys at the cottage. It brings different emotions, different feelings, and I'm sure there's a lot of my listeners and viewers right now thinking, when the kids moved out of the house, it was different. And then before you see them again, then when you do see them again. And so it's appreciate you sharing that with us. Like I said, I got a little taste of it, and hopefully I'm with Carson only being 13. We're quite a few years away from full empty nesters, but we can get a little taste of it already when Lexi goes off to college.
Yeah, you certainly said it well there. It's definitely different. It's exciting. Like I said, most people don't like the boomeranger, so I got two of the older ones back, right? So I actually enjoy it, to your point, Tony and Jason.
Yeah, that's neat. Well, I'll tell you what, Keith, I'm glad you're here. It's a huge get, senior portfolio manager over there at Gradient Investments. And we need to find out what's going on, what the outlook is for the markets and what's been going on and what we need to know. And we're going to jump right into that as soon as we let our listeners give them a chance to get a copy of Jason's book. It's called Empower Your Retirement. And Jason, a great book. I'm going to give away more copies of your book. I'm spending Jason's money. I love to spend your money, Jason.
Tony, you do really good at it. And unfortunately, I opened my mouth one day, and this is a couple of years ago, Keith. I said, "Hey, Tony, go ahead and give away a few of my books on the show today." And the phone started ringing like crazy the next week, and we gave away all the books. And then Tony got this great idea that says, "Hey, why don't I give away 10 books every show?" And I said, "Great, okay, that's fine, Tony." Keith, now before every commercial break, he gives away 10. So now I'm giving away 20 to 40 books a week, and it's starting to get expensive, Tony. But but really, for my listeners, please take advantage of this. Please, please, please call the office. Listen to Mr. Tony Shore when he says to take advantage of this free book offer. I want to share this wealth and knowledge. I want to share this information with you. So please listen to Tony.
Yeah, it's a great book. A lot of great information about retirement planning, investments. Pick it up. All you have to do to get a copy at no charge, no postage. Jason and his team at Great Lakes will mail you one, a book at no charge. 989-835-7203 is the number to call. Call the office, and the first 10 people to leave a message saying they heard about it on the show. You have to say that, and you want a book. They'll send you one out at no charge. 989-835-7203. And you are listening to your Financial Empower Hour with our host, Jason Cryderman, and our very special guest today, Keith Gangl. Jason, what's the first question you have for our esteemed guest today?
Yeah, so I think it's really cool. Again, I will thank Gradient Investments for allowing us to always access their portfolio managers to come on the show and be guests of ours and kind of feed my listeners and myself and you, Tony, with what I call from in the trenches, right? So from Keith Gangl, senior portfolio manager, one of the best managers I've ever met in my 25 years of being a financial advisor. He is a senior portfolio manager for Gradient Investments. And so I love being able to pick their brains again, what's going on in the trenches. And so today we're going to talk a lot about Q2 earnings. I know that's been really hot. They were from what I've heard, they were pretty good numbers. So, but again, I want to hear what Keith has to say from those numbers you guys thought in the public were pretty good. They really weren't. Or no, you guys in the public thought they were pretty good, but from in the trenches and a stock market side of it and a portfolio side, here's what it really means when you hear these numbers. And then we'll talk about, how was the first half of this year? Here we are mid-August. So we need to talk about what has happened in the market and the economy, or I should say markets, right? Plural, because there's a lot more than just one market. And I think Keith will do a good job today also talking about maybe some of the large cap, maybe some of the small media, maybe some international and stocks and bonds. And people got to realize there's more than just the market being the S&P 500. So, and a lot of that's going to relate to diversification and allocation, and we talk about that quite a bit as well. We'll talk about quarter two earnings, Tony. We're going to talk about first part of the year. We're going to talk about what the last third of this year, last quarter of this year might look like now with our current scene or scenes we have out there. I want to talk a little bit about the Fed and inflation, because boy, coming into this year, I think we thought and heard different things than maybe what we've actually seen and felt so far from the Feds and inflation. And a lot of it has to do with this Iran conflict and prices of oil and things. So we're going to spin into that. We're going to talk about where do we think this year really does finish, with all this stuff going on, and a lot of it's noise, but a lot of it is legitimate, realities of life, of the stock market, of the economy. And then we're going to probably stop by talking about the midterms and the midterms impact on the markets. So buckle up for all my listeners and viewers. We're going to cover a lot. We're going to jump right in. I want to throw the mic over to Mr. Keith Gangl. Keith, please start us off by talking about these Q2 earnings, and that means quarter two, and all these companies have to report their profits and earnings or losses. Let's talk about Q2 and what it means to the market and the economy right now.
Yeah, great setup. Those are hot topics that we're talking about right now, and we're just wrapping up Q2 earnings. That's the second quarter. Every company reports, a public company reports their earnings 4 times a year. It's Q1, it's back in April. And basically Q2 is kind of, the July into August. It typically lasts 3 to 4 weeks, but that kind of gives us a scorecard of the healthy overall companies. Jason, Tony, you had kids in school, in high school and college, and you ask what the report card is. Well, I'm doing good. It's like, it's great to hear. But when you actually have to see it on paper or on the computer screen, I guess nowadays, is like, that's when the rubber hits the road or meets the road. And that's exactly what happens with company's earnings, right? They tell us that they're going to be good or should be good, and they've been reporting phenomenal earnings. I've been doing this for over 30 years. I'm kind of dating myself that, and if you're watching a video, you can tell by my hairline here. But so I've been doing it a long time, and this earnings season's been just great. The revenue growth for all those 500 companies that we call the market, generally people are referring to the S&P 500. Mm-hmm. The revenue growth has been 15% year over year for the quarter. That is great. And that's the one question, again, if I had to pick one factor that drives the market over a long period of time, it's earnings growth rate and kind of where those collective 500 companies are growing. That's what drives the overall stock market. So we've got a lot of stuff going on. We'll touch a little later on oil and Iran and, mm-hmm. Tariffs and all these, midterms, all these different things that are in the media. And the question I get day in, day out from advisors and clients that I talk to is, hey, Keith, why is the market doing what it's doing? Why has it been so good? Yeah. The market this first half, the S&P 500 year, we're 2/3 of the way through almost as we finish August, is almost up 15%. Again, you pick your day, but roughly say 15%. Sure. Yep. That's a phenomenal number, right? Because last kind of couple decades is 10 to 11%, kind of, which is really good. You go longer periods, it's kind of that 7 to 8%. We're predicting going into this year that the markets, we've had the markets, again, the last 3 years have been 25, 26, and like 17, 18. Again, that's the S&P 500. And then we get questions, what do you think this year is going to bring? And we were fairly positive. We thought, maybe high teens this year, which is kind of basically an outlier compared to a consensus, because we were looking at earnings growth rate and we didn't think they would be this strong, but they're coming in better than expectations. And I think that's why it's ignoring all these different pieces of noise. Again, we'll get into it later on the show about, the midterms and kind of some of what that may mean, oil prices, what that may mean. But bottom line, this earnings season has been great. 15%. Normally, we haven't seen that kind of revenue growth rate quarter over quarter since Q1. That was coming out of our 2021. That was coming out of the COVID shutdown, right? Because everything got depressed. And then we had accelerating earnings and revenue growth. We're doing that coming out of a non-recessionary period. We're in some really golden times of earnings for companies. It's revenue growth rate and earnings. Earnings projected for this year, just so you know, are about 25%. That is really, really good. If you go look at a long history, 7 to 8% is kind of the normalized number. So last year we did 16. And I thought, okay, if we could do high teens, that's why I was positive on this year. Now that Q1 was so strong, Q2 was even stronger. Those estimates for the full year are now at 25% plus. Wow. That's a big number. And that, I think, is the key factor driving the overall market going forward.
That's huge.
Yeah, those are big. Those are big. So, to reiterate that, I guess, when we, myself and my listeners and viewers out there, when you hear quarter two earnings and you hear this, they beat expectations. What Tony and Keith are kind of, they're listening and hearing and tell us expectations were already pretty good. Right. They were pretty good expectations, but a lot of these companies exceeded those pretty good expectations, which means it was really, really fantastic. Like a lot of earnings were above and beyond and kind of outshot. But that's kind of the spectrum we're on right now is things are really, really good from a corporation standpoint. So, I think that's important to point out because a lot of people, whether you talk to your friends or family and it's like, gee, or my clients, right? It's like, gosh, everything costs so much money. Like the cost of gas, cost of bread and milk and all this stuff is so high. But when these companies are showing profits like that, when they're showing their earnings are up like that, that means like just street talk. That means people are spending money. People are spending money, and I talked to some other analysts and some other listening to other shows and everything. People are buying more gas now at over $4 a gallon than they were when it was only $2.50 a gallon. They thought that was expensive. People are buying more supply. People are spending more money on things now that are more expensive than they were 2 or 3 years ago. Yet we complain about things being expensive, but what that tells me is not only are these corporations obviously strong and healthy if they're showing fantastic earnings and outshooting their expectations, but it's also telling me there's a majority of the consumer that's really strong and healthy and not afraid to spend money. So that is, to me, that's a positive. That's two extremely positive things when people ask, gee, why is the market doing what it's doing? Are we going to go into a recession? Well, when you have a strong spender, when the economy's, people are spending money, corporations are making profits.
Yep.
To me, those are two really positive signs for a healthy economy and a healthy stock market.
Yeah. So the consumer spending money, they drive about 70% of GDP. So
that's huge.
You're exactly right. That's a big number. So when they're working, they're spending. And like I've told you guys before, there's no one that can spend like the U.S. consumer. So when they have a job, they will spend. I mean, obviously, we're all about the same age. We talked about our kids and family. They're not afraid to spend. And a lot of them don't even have incomes yet, but they're spending, driving the economy forward. But AI has been kind of driving some productivity within those companies, and that's what's helping boost those earnings growth rate. But revenues are good because consumers like to spend. Now, there's certainly things we have to watch out for. Price of oil, like you just kind of touched on. We're at in Michigan, Minnesota, usually about the same similar gas prices, over $4 a gallon. Yeah, it's not great, especially for that demographic that's kind of getting paycheck to paycheck. That certainly is an issue, but there's a lot of people that, are in the markets when they're seeing these returns of 10, 15, 20%. So that's helped cushioning it from that standpoint. But I do worry that if oil prices go, 4 goes to 5, the price of barrel right now, generally speaking, is about $80 to $82. It's volatile, right? We had the Iran situation where you came into this year, it was around $65 a barrel. Gas prices at the pump were closer to, low threes. And now we spiked up at one point in time to like 120 on the price of a barrel of oil. Then it dropped back down to below 70. And recently, again, as this kind of ceasefire, non-ceasefire, who knows? It's
who knows what's going on.
Who knows? It's a day to day. That's why that's why when I tell you we invest, we look at company earnings. We don't. All this other stuff is it can factor into company earnings, but a lot of it's noise. So we want to keep an eye on the ball, which is company. Who knows what's what tweet's going to come out and where the price of oil is, because now we're in the low 80s. I think that range between say 70 and 80, 85 is okay. You start getting to where it's sustained at 95 to 100. That becomes more of a headwind for the consumer, which again, they drive 70% of the overall economy. That could be an issue. So that's one thing we are watching closely. Again, there's nothing we can do about it because we may get a tweet, things are resolved. We may have a bomb blow up somewhere else and a refinery or something like that, and oil prices go back up. So we do have to be aware of it, and we just can't be as good as these earnings are. I do think the market could even be better if we wouldn't have some of these headwinds like the price of oil and some other stuff that's going on.
Which is amazing. The market is so resilient. and has been doing so well despite all these things with oil and everything, which surprises me. But again, consumer spending has been up, so that's good. Well, hey, we need to take a quick break before we continue our discussion and continue to get that market update from our guest, Keith Gangl from Gradient Investments. Listeners out there, here's what we're offering: a no charge, no obligation consultation with Jason and his team there. All you have to do to set that up is call 989-835-7203. Whether it's just to ask questions about what you hear on the show, maybe you want to get a second opinion on your finances, or you don't have a retirement or an investment plan in place, a written plan, and you definitely need that. Call 989-835-7203 or go to GreatLakesInvestmentAdvisors.com. And this is your Financial Empower Hour. We're here with our host, Jason Cryderman, and Keith Gangl. Keith, thanks for coming in. You were talking before the break about how the company's earnings have been up, and that's good, and that's been driving these markets, which have been doing well, in spite of the fact that we're looking at high oil prices. Gas prices have been high, at least. The Iran war, people are concerned about where the interest rates are going to go, looking at inflation and the jobs numbers. It's weird. If you listen to certain news, you'd think, oh man, the economy's crashing. But if you look at the markets, it's doing well.
Yeah, you're exactly right. Because the markets are just kind of plowing through all this. And there's always concerns in the market. Again, I've been doing this for over 30 years, and there's always, whether it's oil prices or the Fed or some kind of conflict somewhere, there's usually some kind of issues going on. So the next big thing we can talk about is kind of where the expectations for the Fed are. The Fed this year, the expectation going into this year that we'd actually the Fed would be cutting rates. Our opinion was the reason they cut the rate is kind of spur the economy if things are slowing. We're like, economy's doing pretty good. I don't think they need to cut rates because, they have a dual mandate: full employment's pretty solid. And then they also have stable pricing, which means you don't want inflation going up. You guys remember 2022, right? When eggs and gas and everything was so expensive. That really hurts the consumer. Yeah. All that 70% of spending, that's a big headwind. So that's why the Fed does not want to see inflation. So people are saying they're going to start cutting rates. That was the expectations in the beginning of the year. We're like, I don't think so. I was more in the camp that I think we're just going to stay where we're at. I think we're fine. I don't think we're too hot, too cold. Economy's doing well enough. They don't need that extra kind of boost. And then now, fast forward to, after this Iran conflict, we had oil prices spiking up, which we just talked about a little bit earlier. And when they spike up, that is a key driver in inflation. So we've seen that inflation, the Fed's target is 2%. We've seen that increase to above 3%. It was hanging around that 2.3 to 2.8, which, again, I think that was close enough to 2 to be fine. But then it went to 3.5. Then a couple months ago, we actually had a 4 handle on it, above 4%. Mm-hmm. And now this last month, it reports once a month. It was back down to around 3.4, 3.5%. I think that's okay. I think directionally, we're going to head back towards 2. I don't think we get there. So we're probably going to be more sticky, more elevated. But that's part of it's driven by the price of oil. And like we talked about earlier, that can change in a drop of a hat because it's something, there's a peace agreement, things like that. More companies are pumping oil. That price of oil can drop from that, $90 back down to 70 in that range. And I think that inflationary pressure kind of gets alleviated. So the funny thing is that you go back about a month, 6 weeks ago, markets were they went from expecting a cut of 50 basis points to now the expectations are for a 50 basis point increase. I'm still holding firm. I think we stay flat. And now with that inflation number we've seen recently coming down a little bit, the expectations now, the market's probably more like one basically raise, which would be 25 basis points. And you guys know President Trump. Do you think he wants any kind of increase in the Fed funds rate or interest rates going up?
I don't think so. I don't think so, Keith. I don't know him personally, but from what I know about him and his policies, and he does not want interest rates going up. He doesn't think that's going to be very strong for other aspects of the economy. And so I kind of agree with that on some aspects. And I mean, interest rates is interesting. If you're sitting here as a listener and viewer, you're thinking, wait a minute, I want interest rates high when I invest my money. Right. So we always talk about this. We've talked about it on the show, Tony, with Keith, with Tyler, everybody. You got to look at interest rates as a dual-edged sword. Okay. Meaning when we invest money, we want high interest rates. When I put my money in a CD, I want 5%. When I put my money in any kind of investment that's going to give me an interest rate return, I want a high interest rate, whether it's a CD, an annuity, anything give me an interest rate. I want high rates. But when I borrow money to buy a car, buy a cabin, buy a house, I want low interest rates. Well, what people don't understand is an interest rate is it comes in one flavor, right? I mean, it doesn't come in high and or low. It comes in an interest rate is the interest rate. So if we have high interest rates, that could be good for when we're investing our money. We can make 5% in a CD again. But that's not going to be good when we're trying to borrow money or when corporations are borrowing money or entrepreneurs are borrowing money to grow businesses and build business and all stuff. That's not going to be very favorable because there's not going to be as much growth with higher interest rates. It's actually a deterrent for people to grow and buy and take mortgages out. Whereas low interest rates is a boomer for businesses and entrepreneurs and people to take out more loans and spend more money and buy more stuff and grow businesses. That's an incentive with low interest rates. Unfortunately, when we put money in a CD and we make 2 or 3%, we're not happy with that side. So interest rates are a double-edged sword. They're really a bugger, but they are so powerful on both sides, the consumer and the we'll call it the business side, I guess, of the market, aren't they, Keith?
Yeah, for sure. You summed it up well. So it's a double-edged sword because when rates go up, generally you're going to spend less, but for the people that are in retirement that have a lot of money, that's actually not a bad thing. So but again, if you go back to that's 70% of the economy is driven by consumers. That means they're spending. Generally speaking, if you're a spender and even if you're a retiree, if you have kids or grandkids, you probably want a little bit lower of an interest rate for them to borrow for a house or a car, that type of thing. That spurs the overall economic activity. That's one thing the last couple of years have been a little bit stagnant, in Minneapolis and in Michigan as well. I'm sure is the housing market. It's been strong, right? But it's people are less mobile than they used to be because rates are higher. Everybody's reference points is the 30-year mortgage. I was at 3% a few years ago, and now they're around 7%. I do think that's they'll be in that 5.5 to 6.5, 7. I think that's the long-term normal averages. I think that's a healthy kind of both between the borrower and the saver are right. I think that's a nice spot in between.
Yep, I agree with you. I think when we got mortgage rates down in that 1, 2, 3% range, I mean, that was just, I think everybody loved it if you could refinance and get such, but we all called it what? Free money. We all call, your interest rate is 2%. It's like, that's free money. Well, nothing free is, that's not good for the overall economy. So there, like you said, there has to be a happy medium where the consumer's not getting gouged, but the business is making a little bit along the way as well. So there has to be a happy medium.
Yeah.
I think that's where I think the Fed's just going to be on hold. So again, the only reason I brought Trump up was the fact is that he's pushing for lower interest rates. The Fed is independent. They're going to do data, analysis of all the stuff that goes into making their decision. But obviously he would like lower one to spur the economy to kind of get it more hot. Then you have to be careful. It gets too hot. Then you have high inflation, kind of where we had 2022, which is bad for everybody. So high inflation is bad. So that's why I think but I don't think they need to raise rates. I think inflation on its own will slowly come back down. So I think we're in that, Jason and I, you're in agreement. I think we're in that kind of a nice normal range. It's people get used to that 7% mortgage again. Tony, you probably all had at one point in time mortgages above,
well above
30-year.
Well above that.
Oh yeah. Right. And then your refinance went lower. And I think we're just in that normal range. And, unfortunately housing prices have gone up a little bit. So that there's an affordability problem, but we'll have to figure out some other ways, more supply coming online. Maybe that would help alleviate some of that stuff. But there's a lot of things going on in the economy and Feds and interest rates and price of oil. Those are all things when we're making stock and macro decisions that we consider all along the way.
Yeah, I think that's huge. Now, we do have to take one last break here, and we're going to give away 10 more copies of Jason's book, Empower Your Retirement. And what a great book, Jason. our listeners can get a copy sent to them, no charge, no postage, no obligation. Just call 989-835-7203. That's 989-835-7203. And say you want a copy of Jason's book and you heard about it on the show. And you're listening to your Financial Empower Hour. Jason, we have the greatest guest. If you want to talk markets, this is the guy. People have seen him. He's been on some of the major financial news channels, and you've been a senior portfolio manager over there for a long time, been doing this a while. Keith, Jason, we're lucky to have him today, aren't we?
Yeah, it's always awesome when I get the opportunity to have somebody like Keith Gangl, the senior portfolio manager of Grady Investments, on our show. It's awesome. And I tell all my listeners and my viewers, and whenever I'm meeting with my clients and my families, I say, hey, look, if you can listen to this show this coming week when Tony's going to be on there with Keith Gangl or with another one of those portfolio managers, it's awesome. And the reason being is because, Tony, you and I only know so much. We kind of sit up on what I call, like, we're not in the trenches, right? We're up on the playing fields of investing, but Keith Gangl and his team, they are down in the trenches. I mean, they do all the research, they see all the goods, bads, uglies. They need to know why they make decisions that they're making. If it's a good decision, great. If it's not, it's just truly deep in the trenches of what the heck is going on, not only in the United States, but around the world, because there's not only U.S. markets, there's international markets and international impacts on our U.S. markets. So, yeah, Keith, thanks again so much for being on the show with us. I greatly appreciate having you. Thanks for sharing. Obviously, you dated yourself, not me, but I believe you did say 30 years.
Yeah.
That's a long time, man. I've been doing this for about 25 years. And so I'm trying to catch you someday, man. You got to slow down out there. But so let's end. I know we got, probably 6-8 minutes so here left in this show, but let's end today, Keith, talking about where you think we might finish the year based on, we talked a little bit about interest rates, maybe earnings, maybe, profit, these types of things in the market overall. But we need to talk something. I never, ever, ever like talking politics when we talk about our portfolios, right? You preach it. I preach it. Everybody should preach. Do not let politics and portfolios mix. They don't give a crap about each other, and they never should. But it is important we at least talk about there's midterms coming up here, and it could have an impact on the market. So without allowing politics to drive your portfolio, without allowing politics to have an actual impact of why and when you buy, sell, and trade in your portfolio, let's talk about how the midterms might have an impact on the markets as we close out this year.
Yeah, thanks, Jason. By the way, you're great to work with. Not only do we do these shows together, you and I talk, during the week as well on different ideas that come up. So your clients are well informed of what's going on with the markets, and you nailed it on the head with the politics and midterm elections. It's important to discuss, but from a kind of there's gonna be a lot of noise, blue and red versus blue. What we want to focus on, which we started at the top of the show, is company earnings. We're focusing on making green, not red or blue. Go vote for who you like. You're in Michigan, we're in Minnesota. It's going to be obviously a lot of interesting. There'll be a lot of noise out there.
Absolutely.
But what we do as investment professionals is we're looking at those company earnings. Are they going to change because of elections? In most cases, it's a lot more noise than actual change that actually happens from the investment standpoint, right? There could be some policy changes and, this way or that way. But what we're going to look at is that number I started the show with. This year, the earnings growth rate is going to be 25%. That is phenomenal. That's what's going to move the market. Now, that being said, we have to be aware of midterms, because historically, when we have midterms elections, the markets they sell off a little bit. It's roughly around, again, historical averages around between this August timeframe to election because of uncertainty and more concern. There'll be a lot of noise. The sell-off on average has been 3 to 5%.
Yeah, I mean, it causes a little bit of volatility or turbulence, right? We talk about Tony's daughter being a flight attendant, and so turbulence. And these generally are more turbulent times or rougher air.
And so you do a great job with your clients because
it's rougher air.
Yeah, you do a great job with the clients because you diversify them. They're not all. I mean, we've been talking about the markets as a whole, kind of doing these numbers we talked about, but most of your clients are going to have some of that. They're going to have some safety, some other things as well to kind of mute that turbulence, even if we get it. Who knows if we're going to get it or not? But as I manage the portfolio as well too, I kind of look at this time period like, okay, we could have a little bit of a pullback. We've had, again, I do think the markets between now and year end finish higher, and just because of that earnings growth rate. Now, if we start looking into next year, 2027, I'll give you a little sneak preview of kind of what I'm thinking for 2027. It's early yet, but I do think earnings have been so strong the last couple of years that at some point in time, your year over year change, right? If we do 25% this year, it certainly is not certainly, but I doubt it's going to be 25% next year. You can more have that normalized range of 7 and 9%. Right now, the market's forecasting 17%. I think that number for next year is too high. It's too far out, but that's too high. If we can do 10%, I think I'd be happy with that. But maybe if that's the case, maybe we have more of that normalized year. When you're talking normalized year, that you're talking back to the 8-10%, which people will be like, what? I'm used to 15s, 18s, and 20s. But that at some point in time, we're going to have a correction or a pullback. And you do a good job with your clients of keeping them in the market, but not having them overexposed as well.
Yeah, I think that's important to point out right there, Keith, and I hope my listeners and viewers really caught that is, we had the market in the last 3 years went up, 24%, 26%, 17%. This year, I mean, look where we're at this year, 15 plus, and we're looking at being even higher by the end of the year. These numbers are not normal. Okay. From an investment advisor, I'm a fiduciary advisor, been doing this for 25 years. These numbers are not necessarily normal or healthy to sustain and continue this growth long term. That's just not what the market in our business cycles do, right? So what Keith just said is we might see more volatility, more turbulence. We might see a pullback. Doesn't mean we will necessarily have a negative market, but instead of being up another 17 to 20% next year, maybe it's more realistic. The market's only up 7 to 10. That's more normal. That's when we talk about the consumer side of the market and corporation side of the market. It's pretty tough for everybody to stay strong and healthy in a 20 plus market every year. That's pretty tough to do and consistently achieve higher. So some pullback, some volatility. It's like NASCAR. You watch NASCAR races or any kind of race or football, baseball, basketball. They take breaks. They take breaks. They got to sit down, get a drink of water, relax, let the muscle, and then get back out there and play the second half, second quarter, second part of the race. The stock market really is the same, right? Sometimes these corporations and even the overall economy has to slow down, has to take a break, get kind of rejuvenated, regenerated, and go back out and try to perform again. So thanks for sharing these numbers with us, Keith. I mean, these are some big numbers we've talked about. There's some huge topics, but again, from in the trenches, it's tough to get it from people like you. And I greatly appreciate your time and the wealth of knowledge you share with all my clients and all my listeners and viewers.
Thanks for having me on again.
All right. Well, guys, we're out of time. Great discussion today. Listeners, one more time, call 989-835-7203 to get a copy of that book. Be one of the next 10 callers. Jason's book is Empower Your Retirement. Or set up that no charge, no obligation consultation by calling 989-835-7203. And that does it for today's episode of your Financial Empower Hour with special guest Keith Gangl and our host, Jason Cryderman.